So today's topic is financial management and function. Now, what is this all about? Financial management and function. See, a company is managed by many of the managers in various departments. Finance is one of the departments. So who will manage the finance of the company? The financial manager. He will be under CFO of the company. Okay, Chief Financial Officer. So this Chief Finance Director will make the strategies. CFO will be implementing financial. Will be these all team will be involved in making decisions or taking financial decisions or preparing financial strategies of the company. Financial manager will implement them, and the analyst and the officers will be working on that. Okay. So now, what is this financial management all about? See, if I tell you one thing, financial management is all about acquisition of resources and deployment of those resources. Now, what do you mean by acquisition of resources? See, acquisition of resources is nothing but purchasing machinery, plant, building, preparing site for production purpose. All this is nothing but they acquire all this. Okay, and for that they also arrange finances. So they will arrange finances, acquire all the resources. Again, I'm saying they will arrange finances, acquire all the resources like plant, machinery, building, land, etc., and they will deploy all these resources for achieving the objectives or goals of the organization, which is nothing but to make the organization profitable. That is what the financial management process is all about. So financial management process is nothing but acquisition of resources and deployment of resources for achieving the goals or objectives of the organization. Now, under financial management process, this financial management process is, or the entire syllabus of this book is divided into three parts: financing decisions, investment decisions, dividend decisions. Financing decision is nothing but financial manager of the company is going to see what are the options available for company to raise finance, or what company is eligible to get. Okay, see, every company cannot go for an IPO directly. When you start a company, or there is a startup like which you have founded, or you are a founder of a startup. Okay, you know that there are so many challenges. People won't, the general public won't be investing in your company until and unless they see some promising results from your company, right? If like if your company is a very established company, since many years you are into business, as you have a legacy of 100 or 50 years, then you come out with a new project and you want to raise funds, or you want to arrange capital by issuing shares to public or asking public to take ownership in the company. See, public will take ownership in the company only when they trust. Okay, no one wants to take higher risk in this world. If they're taking risk, that means they know what kind of risk it is, and what they can expect out of that investment. So they always want to play safe and put their money into some companies which are trustworthy and which are delivering good results since many years. Okay, so like you will be arranging finances for company that can be in the form of debt, equity, or preferred stock, and you will be looking what is the cheapest source of finance for your company. First of all, you will check your eligibility. Second, what finances you are eligible to get. And third, if you're eligible to get some finance, then you'll be doing a comparative analysis, right? Whether suppose there's a bank A and bank B. Bank A is giving a loan at 10%, bank B is giving a loan at 14%. You'll go for bank A. Now, why there is so much of difference? That is not something you are supposed to decide. You will just take or pick up the opportunity where you're getting the capital at less cost. So least cost capital is what you'll be looking at. Then investment decision. After arranging the finance or arranging the capital, you will be investing that money, right? Now you will be undertaking certain projects in the future, some potential projects. It's not like you're going to invest your money and wait for the results. No, on papers, before investing, you're going to see which particular project is going to be better project for you. But let's say there are two projects, A and B. Okay. So which project is better? How to decide? There are certain models or methods which will help you to decide that. For example, payback period method. This is one of the models. So this will help you to decide which project is better, whether A or B. Of course, anyone in the world knows which the project which gives you higher returns, or the one which is more profitable for you, is one you're going to like select or pick. Fine. Then there is NPV method. Then there is IRR method. Then there is profitability index method. Then there is ARR method. These are all methods. We will not discuss about them today. First class is the basic class. We are only going to take, we are only going to understand how these methods work, but not all. I'll just pick up this one. Let's say project A's NPV comes to $10,000. Project B's NPV comes to minus $5,000. Now, common sense says always pick the positive figure. Yes. So NPV rule, see, we are going to calculate NPV of a project. Don't worry in the coming sessions. But what does NPV rule say? NPV rule say, or NPV method, after applying this model, you'll get some output out of it, some answer. If the answer is positive or NPV is positive, you can pick the project. If the NPV is negative, you can reject the project. So here we'll accept this, right? Once the project is picked up or accepted, then the bigger challenge comes. You have to start reporting, okay, everything about it. So you have to prepare the financial reports, and at the end of the year, you will be getting results from those financial reports. Of course, reports are prepared to check the performance. So if the company is profitable, then you need to see whether you have to pay dividends to the shareholders or not. If you decide to pay dividends to them, then what? That comes under dividend decisions. So how much dividend should be paid? How much profit should be retained? What they will be doing with that retained profits, where they want to reinvest that again in the future. Everything is a part of dividend decision. Okay. So all this what we discussed, you will find it here. Financial management, acquisition and deployment of financial resources to achieve key objectives. Acquisition, I told you. Deployment, I told you. So acquisition is nothing but under the financing decision. Deployment is nothing but you're investing your money, and also at the end, when you get profits, you're going to decide how much profit you're going to retain and how much you're going to give as dividends to shareholders. So that's what comes under dividend decisions. And also one more thing I will tell: in today's world, no company is taking decision without integrating risk in their decision making. That means if they have to take any crucial decision, they have to also see what are the risks involved in that project or in that decision making, and how those risks can be minimized. That is also a most important aspect. Henceforward, today many of the finance courses are having risk management topics as well. Just wait for a second. Just a second. Now, key financial objectives. Of course, every company or business wants to earn profit, and this happens to be their main financial objective. Every director, what kind of promises they make to shareholders, that they will maximize shareholders' wealth and they will make the organization profitable. Yes. So, but only profit is not everything. The sustainability and future performance and profit should rise every year. All these factors are also very important. So see, in fact, this is not the assumption made in financial management, and in reality, shareholders often express disappointment in a company's performance, even when profits are rising. Yes, because they want more. This suggests that profit is not sufficient as a financial objective. Yes, only one of the aspects is not important. If an investor looks at many areas, right? So we'll discuss everything in details afterwards. But there's a activity in front of you. First question. Try to answer this fast. I'm waiting. Yeah, please try to answer this.
Sir, this C.
See, yeah, sir, we'll see. B company has just revealed its financial statements for the year and its profit before tax increased by 38%. So PBT has increased by 38% over the previous year. So that's a good thing. So previous year, let's say if $100 was their profit, this year their profit is $138, 38% jump. This was due largely to a doubling of sales in Southeast Asia. So in Southeast Asia, their sales have doubled. Of course, if there's a doubling of sales, we can expect good profits. Am I right?
Yes.
Yeah. So the share price in B company fell by almost 20% immediately after profit announcement. So this is a very rare case. When there are good results coming out, and if suddenly the share prices fall, then what can be the reason for this? It is highly impossible. So let us now understand what the question they are asking. Which of the following is the least likely? See, please try to give lot of emphasis on this word. Which of the following is least likely explanation for fall in share price? See, sales in Southeast Asia has been expected to increase by more than 100%. If sales increase by more than 100%, there is no chance that the share price will fall. Yes? If the sales are expected to, suppose $100 sales you're doing and it is expected to become $200, do you think the share price is going to fall? Never. Like increment in revenues is a good sign, positive signs. So people are going to pay more price for the share. So I think this is the least likely explanation. But yes, as Mateen sir, you have given third option. Let us discuss that also and try to take the clarity on this. Depreciation charge was higher due to a change in accounting policy. Of course, if depreciation charge increases, that means depreciation expense is increasing and it will definitely decrease the profits. If profit decreases, the share price will fall. We are looking at least likely explanation that the share price will fall, not the most likely. So increase in depreciation can be a most likely explanation of fall in share price. We are looking at the least likely. Then the level of B company risk has increased over the year. Yeah, see, increase in risk also is something which can make the which can make the share prices to fall. Yeah, if risk is increasing, if level of B company's business risk is increasing, then it creates a risk on the shareholders, right? So what will happen with that? The shareholders, when the risk is increasing, the shareholders will be, not much interested to buy the share, and the share prices can fall due to less demand. And so, do you think this can be the reason for fall in the share price? We are looking at least likely, not most likely. Yes or no?
Yes.
So, sir, this can be a most likely reason of fall in share price. Depreciation expense increases, profits decrease, share price decrease. Most likely reason. We are looking at least likely. Now, increase in the risk will create fear amongst the shareholders, and they'll show less demand for shares. Prices will fall. Delay in the launch of new products, not a good sign, not a good indicator. That means company is very slow paced. This is also one of the reasons the share prices may fall. All these are the most likely reasons. We are not looking at most likely reasons. We are looking at least likely reasons. So the least likely reason is, if the sales increase, the share price will never fall. Okay. So this is the option. Have a look through this. We'll immediately move forward.
Sir, this page number is what, sir? Page
No,
number,
sir,
can you
this
tell
is
me?
FM book, sir. I will share the this thing to you within a second, sir. Just a second.
Yeah, sure. No issue.
Sir, just wait. I'm sharing with Prasanna and with you also, sir. 2 minutes.
Okay.
I've shared. Now, profit as a financial objective has number of drawbacks, of course. So if you think that profit is everything as an investor for you, yeah, of course it matters a lot for you, but this is not the only objective you should be looking at. There are various other objectives you should be looking at, because profit, if you go with the profit figures, there is a lot of chance that accountants may manipulate this and show a wrong figure to you at times. Okay. See, it is not only you see the profit figures, you see the bank balance of the company, assets of the company. You see how much assets they have bought in the previous past, or in the recent years, and how they are expanding their business. All these factors are also very important. So those show the real picture, but profits are very subjected to manipulation. So it is historic and is not future oriented. Of course, you can see predictions are different in the world of in accounting. We don't have any scope of predicting the profits. Yeah, in costing and management accounting, they prepare budgeted financial statements, etc. It therefore does not measure the future potential of a company. Yes. So, if the profits today are high, even, it's not a guarantee that in the future the company is going to grow definitely. Why? Because the next year profits can also fall. So future potential of a company depends upon the future projects, offers, or the investment what they are doing heavily in the technology. Now today India has like we see the AI, and there are there are, I won't name the countries here. Some countries, the world's superpowers are very active and in advanced stages of AI. Like we won't say that they're at the most advanced stage or the highest or peak, but we are just beginners. We don't have our own GPT till now. We don't have any LLMs till now. We are still working. Like we are not successful till now. But even though India is third rank, India is at third rank. Yes, many other countries are not in the race even. Okay, so what is happening if companies invest their money in futuristic technologies or become first mover, or enter into the market, and they have the first mover advantage. Now it does not measure liquidity or risk. Of course, profits cannot tell you about the liquidity risk, and of course it can be manipulated. There are certain expenses which will not be shown in the books, in the statement of profit or loss, and will be added to assets and shown in the balance sheet. So most of the expenses added to asset value and shown in balance sheet are not shown in P&L, which will overstate the profits of the company, and it's a manipulation. Now, let's now understand some point. Profit and profit based ratios such as EPS will continue to be monitored by investors as they are evidence of the returns that have actually been achieved by the company. Yes, EPS is one of the measures which, or one of the ratios every shareholder wants to know, because profit is what they are looking at the end of the year, and they want to know how much company, if that profit is distributed amongst them, how much each and every shareholder is going to get. Let's say company's profit is $100 and the number of shares, like shareholders holding the shares are 10. So there are 10 shares. If I divide $100 amongst 10 shareholders, each one is going to get $10, right? It is current year they got $10. Previous year they got only $7. Which is better? Of course, current year. So in this way, the shareholders can be satisfied with the performance to some extent. Again, performance is subjective. It is some shareholder emphasizes profit, some shareholder emphasizes liquidity, some shareholder wants overall performance. So it's like subjective again. One point I would like to tell you, profit distributable to shareholders. You can only find this in this way. PAT minus preference dividends whole divided by number of outstanding shares. Please make a note of this formula. If you have, if you don't know this, please go for this. I'll move forward immediately. See, of course, wealth maximization. What you think of wealth maximization? Let's say you bought a stock for $100. ABC Corporation, you are an investor in this company and you bought $100 stock. It has now become $150. Of course, you're getting what? 50% gains. This is called capital gain. This is the return what you were looking at. But do you think this is the final return? No. Company will also give you dividends. So let's say company gave you dividends of $10. Okay. And your investment is how much? $100. So you got 10%. This is called dividend yield ratio. Okay. So total shareholder return is always a combination of capital gain and dividend yield. These two combined together is your total shareholder return. How did you get capital gain? 150 minus 100 by 100 into 100. I'm converting this into percentage, plus $10 they gave you the dividends by 100 into 100. Whole thing is in percentage. 50% plus 60% gives, 10% gives you 60%. Make a note of this. This is your capital gain. This is your dividend yield. Whenever I speak about yield, I tell you, I already told you that you should take market price. Okay, next. There's one more formula as well. So TSR is nothing but current price of the share P1 minus P naught plus D whole divided by P naught into 100. So I'll write it fairly. This part is again the capital gain part. This part is the dividend yield part. So for you to get a better understanding, I'm using all this, but you can directly use the formula and do your question. Okay. And then you get your total shareholder return. So do this question fast. I'm waiting. Are you doing this? So there is a shareholder who purchased 1,000 shares in SJG company on 1st Jan. Market price is 2.5. It has gone to 2.82. So 2.82 is the current price. 2.50 is the price at which I bought the share. And 28 cents is my dividends. So whole divided by my investment value is 2.50 I invested in 200. You see what are you getting?
Zero point 0.24, sir.
Yeah. No. Yeah. So you're getting 24%. Fine. Convert that into percentage. Yes. Let's move forward. There is a question here. Calculation of financial objectives. Read this activity. Magneto PLC has objectives to improve EPS and DPS by 10% per annum. EPS, net profit minus preference dividends divided by number of outstanding shares. And DPS is nothing but dividends by number of outstanding shares. Okay. Now they have given the current year profits and previous year profit. We see the improvements. They have given the interest. Those will be fixed. Tax. You have the profit after interest and tax. Preference dividends are given. Those will be fixed payments. Dividends are given. Retained earnings. Number of ordinary shares. And current year share price and previous year share price also is given. Fine. What are they asking? They're asking you to first find out the EPS for the current year. What's the formula for EPS for the current year? You have to first take the profit after interest and tax, 14,508. You have to subtract what from that? Preference dividends. 14,508 minus 200 whole divided by how much is the shares? 1 lakh. Now you tell me what is your EPS fast. 14,300 by 1 lakh will be 14.3 cents. Yes or no? Done. Go for the next one. What is the growth in DPS? So to know the growth in DPS, you need to first find out the dividend per share. So what are your dividends? 7986 divided by 1 lakh. Find out this year's dividend. Find out the current year dividends per share. It will be 0.07986, 0.08585. 0.08585 minus 0.07986 divided by 0.07986 into 100, 7.5%. Answer.